Warren Buffett is CEO of a company called Berkshire Hathaway, and as CEO, he releases a letter to shareholders every year. Now, much of the content in these letters is dedicated to discussing the financial results of the company, but Buffett seems to relish every opportunity he can get to teach others about investing. For this reason, his annual letters to Berkshire Hathaway shareholders are normally chock full of useful information, distilling very important investing concepts into simple to understand truths, and are therefore really valuable for anyone who is looking to learn how to invest from one of the very best. Warren Buffett released his annual letter for 2022 on February 25th, and I personally felt like it had a more casual tone than some of his letters in years past. And for me, I personally didn't feel like any part of the letter had this one big moment that explored an investing concept that you can't find in any of his other letters. To me, it felt like it covered a lot of the same territory. That said, Buffett's letter in 2022 still had a very important lesson for investor. It was the highlight of the letter for me, and it's what I want to share in this video. Hi, my name is John Quast. Thank you so much for coming by my YouTube channel, Working Capital. This channel is all about learning how to invest, whether it's in stocks or other things, and then taking action. And learning from Warren Buffett is definitely part of that. What really stood out to me in this letter from Warren Buffett was the reminder that even though he's one of the greatest investors to ever live, he attributes almost all of his success to about a dozen investments. Most of his investments, he says, are average, and some of his investments have even been bad. Therefore, it's only about a dozen investments in 58 years that he's actually somewhat proud of. Here's the thing, this isn't false modesty on Warren Buffett's part. It's actually how investing works. By definition, most of the stocks on the stock market are going to be average opportunities. So a lot of the stocks that we buy are going to be average, which leaves just a few on the edges that are going to be bad and some that are going to be good. This is a very counterintuitive concept because we're used to thinking in linear terms. We're used to things being equally good and bad. So you have to pick more good things than you pick bad things if you're going to have success. In reality, the stock market is non-linear. Bad investing decisions have a limited downside, but good investing decisions have unlimited upside. Let's put that another way. The downside of being wrong when investing in a stock is less than the upside of being right when investing in a stock. In other words, the stock market is a vehicle that is out of balance in investors' favor. So we can actually take a stock that Warren Buffett puts forth in his letter as an example of what we're talking about. According to Buffett, Berkshire Hathaway invested in Coca-Cola and finished its investments in 1994. Using a starting point of January 1995, Coca-Cola stock is up more than 800% when reinvesting dividends along the way. For those who don't think in percentages, if you invested $10,000 in a stock that went up 800%, you'd have over $90,000 by the end of that. So let's get in a time machine, let's go back to 1995, and let's pretend that you invested in 9 stocks. You put $10,000 in each one, equally dividing your investment. One of those stocks was Coca-Cola. The other 8 all went bankrupt. And when stocks go bankrupt, the stock goes to zero and you lose all your money. It's hard to do worse than what I just laid out. Even in that scenario, you would have still broken even. And to be clear, that's about as wrong as humanly possible as you can be as an investor. Normally our stocks don't go to zero, they go down or they just perform average like Buffett talks about. To have 89% of your investments, 8 out of 9, go into companies that went bankrupt is statistically almost impossible. Even doing that bad as an investor, just investing that one time in Coke was enough to counteract all of those bad investments. That is how Warren Buffett is winning over 58 years with just a dozen or so good investments. Warren Buffett explicitly laid out the lesson in the letter to shareholders when he said this: "The weeds wither away in significance as the flowers bloom. Over time, it takes just a few winners to work wonders. And yes, it helps to start early and live into your 90s as well." The key ingredient to making this dynamic of the stock market work in your favor is putting time on your side. I know that's not a popular thing to say. Many investors are convinced they can do quite well trading in and out of positions over short time periods. But what Berkshire Hathaway has proven over nearly 6 decades is that time is the ally for the long-term investor, and when you put time on your side, you can do worse than random and still wind up doing very well as an investor. Anyways, thanks for watching this video. Hope that it was helpful. Hope that you enjoyed it. Subscribe for more videos like this. I'm going to try to be doing 2 videos per week. We'll see how it goes. See you in the next one.